Okay, let's talk about AI. The hype is everywhere, right? But it begs a huge question. Is this the real deal, a genuine revolution, or are we just reliving the dot-com bubble all over again? Let's dig in. So, where did this all kick off? You know the answer. November 2022, the day ChatGPT went public. And that wasn't just another product launch. No way. It was more like a starting gun for a gold rush. It unleashed this absolute frenzy of investment that turned the tech world upside down, like overnight. And the impact? It was insane. Get this. By 2025, AI startups were gobbling up a whopping 63.3% of all venture capital in the US. Let that sink in. Nearly 2/3 of all the investment money going to new companies was pouring into this one sector. I mean, we've just never seen that kind of focus before, ever. And if you look under the hood, things get complicated. It's this tangled web of deals. You've got the tech giants investing in the very startups that are supposed to be their customers. You've got suppliers taking a piece of the pie. Yell Insights put it perfectly. The lines between who's a customer, who's a partner, and who's an investor are getting super blurry. Okay, so all of this brings us back to the big question, right? Is all this money and hype actually building the foundation of a brand new AI-driven economy? Or are we all just sitting here watching a classic bubble inflate, just waiting for the inevitable pop? All right, let's play devil's advocate for a minute. Let's look at the argument for this being a bubble. And to do that, you kind of have to look back in time. You have to see if history is repeating itself. And for a lot of smart people, the echoes of the dot-com crash are just, well, they're deafening. There's actually a great tool for thinking about stuff like this. It's called the Gartner hype cycle. It's basically a roadmap that shows how pretty much every new technology travels from being just a cool idea to something we all actually use. And it has these really clear, predictable stages. So here's how it goes. First, there's a technology trigger. Then, excitement goes through the roof, and we hit the peak of inflated expectations. After that, reality sets in, and it crashes down into the trough of disillusionment. Finally, it slowly climbs back out to become genuinely useful. Now, when people look at AI today, where do you think they say we are? Yep, right at the very top of that peak. And the thing is, the scale of this particular peak is just off the charts. You look at AI's slice of the VC pie, it absolutely dwarfs every other recent tech craze. Fintech, mobility tech, even crypto, not even in the same league. And for a lot of folks, when you see that much money pouring into one tiny corner of the market, that is a massive, flashing red warning light for a bubble. And this is where we get to what some are calling the AI valuation paradox. It's kind of crazy, right? You have these startups with basically zero revenue, and they're being valued in the hundreds of millions, sometimes billions. What's going on? Well, investors aren't paying for what they're making now. They're betting on what they could make in the future. And that is the very definition of speculation. You can see this wild excitement in how the market is behaving. We're seeing AI startups just skipping the early funding rounds and going straight for the big money. PitchBook data shows their valuations are on average 42% higher than non-AI companies. And the amount of cash they're burning through is just staggering. I mean, these are all classic textbook signs of a market that's running on pure hype, not solid business fundamentals. Okay, but wait a second. That's one side of the story. There's a really strong argument that says, nope, comparing this to the dot-com era is just wrong. So let's flip the coin and look at why this time it might actually be different. And this quote from Goldman Sachs really hits the nail on the head. They're basically saying, look, this isn't just irrational hype. The reason these stock prices are going to the moon is because the companies are making real money. We're talking massive, fundamental growth in their profits. And if you actually put the two eras side by side, the differences are huge. Back then, you had the whole Y2K panic forcing companies to spend. You had tons of tiny, unproven companies going public, and the accounting rules were, let's just say, a lot looser. Today, the money is coming from massive, cash-rich tech giants, and the regulations we have post-Enron are way, way stricter. The companies themselves are just a different beast altogether. In the year 2000, more than a third of tech companies on the stock market weren't making any money. Today, that number is way lower. And the players at the center of the AI boom, we're talking Microsoft, Google, Amazon, these guys are financial fortresses. They have unbelievably strong foundations. So here's the absolute key takeaway. A company like NVIDIA, its stock isn't just flying high on promises. It's flying high because its profits have literally exploded. During the dot-com bust, valuations got completely disconnected from reality. This time, for the big players at least, the earnings are actually keeping pace with the stock price. And that is a world of difference.
Okay, so the finances look more solid, fine. But what if we're worried about the wrong kind of bubble? What if the danger isn't a financial bubble, but a productivity bubble? A world where we've just completely overestimated what AI can actually do for the economy.
And there's this really fascinating paper out of MIT that dives right into this. The economist, Darren Acemoglu, basically says, hey, we don't have to guess about AI's impact. It's not some magic number. You can actually calculate it. It's a formula. You just figure out how many jobs are affected and how much cheaper AI makes those jobs. So let's actually run the numbers. It's pretty interesting. First, studies show about 20% of tasks at work could, in theory, be touched by AI. But of those, only about 23% can actually be automated in a way that makes sense financially. And when a task is automated, it saves about 15% on average. So when you multiply all that out, where do you land? You land at 0.55%. That's the total productivity gain over a decade. Now, that's not zero, for sure, but it's a long, long way from the revolution we keep hearing about. And why so low? Well, it turns out that a lot of what humans do is really complex and nuanced, stuff that's just really, really hard for AI to learn, and that puts a real ceiling on the economic boost. So, okay, let's recap. Maybe it's not a dot-com bubble 2.0, and maybe the productivity boom isn't as big as we thought. So does that mean we're in the clear? Not exactly. It just means the dangers are different this time. We're looking at a whole new set of risks that are unique to this AI era. And that's the million-dollar question, isn't it? We have to stop looking at the past for answers and start looking at the very specific things that could go wrong with this system, this incredibly complex and super concentrated AI world we're building. Researchers at Yale have pointed out three big ones. First, there's contagion. You've only got a handful of giant companies at the center of all this, and they're all connected. If one of them stumbles, they could all go down like dominoes. Second, governance failure. Imagine a major AI model goes rogue and causes a disaster. The backlash could trigger a global freeze on AI development. And third, something called disruptive substitution. What if a brand new technology comes along, say quantum computing, and suddenly makes all these multi-billion-dollar data centers completely obsolete, like overnight? And all this leaves us with one last big idea to chew on. What if we're asking the wrong question? What if this whole is it a bubble debate is just a distraction? Maybe the real story isn't about a crash that might happen, but about something that's already happening. The creation of a concentration of economic and technological power unlike anything we have ever seen before, all in the hands of just a few companies. And if that's the case, what does that future look like for the rest of us? That's the real question, isn't it?